In the autumn of 2008, the entire global economy came within days of complete collapse. On trading floors around the world, screens bled red as trillions of dollars simply evaporated into nothing. Banks that had stood for over a century vanished in a single weekend. Millions lost everything. This is the story of how greed and reckless gambling nearly destroyed the modern world. For nearly a decade, American house prices had done nothing but rise. Interest rates were pushed to historic lows, money was cheap, and borrowing felt effortless. A home was no longer just a place to live. It had become the safest investment anyone could imagine, or so they believed. It began, of all places, with the dream of owning a home. For years, American banks had been handing out mortgages to almost anyone, no matter how poor their credit, no matter whether they could ever hope to repay. To keep the boom alive, lenders lowered their standards to almost nothing. They offered mortgages with no deposit, no proof of income, sometimes no real job at all. Low starter rates lured people in, then jumped years later. The brokers earned their fees and moved on, no matter who paid the price. Then the banks did something clever and catastrophic. They bundled these risky loans together, sliced them up, and sold them around the world as safe investments. The poison was now spread through the entire financial system. There was one final trick. The credit rating agencies, paid by the very banks whose products they judged, stamped these bundles of risky loans with their highest possible grade, AAA, the same rating given to the safest government bonds. Investors and pension funds across the world bought them without a second thought. For a while, everyone got rich. House prices kept climbing, the banks made fortunes, and the whole machine spun faster and faster. Almost no one stopped to ask what would happen if the music ever stopped. Then, around 2006, the impossible happened. House prices stopped rising and slowly began to fall. Borrowers who had counted on rising values to refinance were suddenly trapped. As their starter rates expired, the payments soared, and one by one, the first families began to default. Then it did. House prices began to fall, and millions of homeowners found they owed more than their houses were worth. They stopped paying. And suddenly, all those safe investments turned out to be worth almost nothing. In March of 2008, the first giant fell. Bear Stearns, a Wall Street bank more than 80 years old, ran out of cash in days. To stop the panic, the government helped force its sale to a rival for a fraction of its former worth. Few realized it was only the beginning. Panic spread through the banks. No one knew who was holding the toxic loans, so no one trusted anyone. The lending that the whole economy depended on simply froze, and then the giants began to fall. Lehman Brothers, a bank that had survived for over 150 years, collapsed in a single weekend. Its fall sent a shockwave of pure terror around the globe. If Lehman could die, no one was safe. The very next day, an even larger domino wobbled. AIG, the biggest insurance company on earth, had quietly promised to cover the losses on billions in toxic securities. Now it could not pay. Fearing total collapse, the government seized control, pouring in $85 billion to keep it alive. One after another, the great institutions teetered on the brink. Insurance companies, investment banks, lenders. The financial system that the entire world relied on was days, perhaps hours, from total meltdown. In desperation, governments stepped in with the largest rescue in history. Hundreds of billions of dollars of public money were poured into the very banks that had caused the disaster to stop the whole system from collapsing. To stop the bleeding, America's leaders reached for an almost unimaginable sum: $700 billion of public money handed to the banks to buy up their worthless assets and keep them standing. The public was furious, but the men in charge insisted there was simply no other choice. The disaster did not stay in America. Banks across Europe had bought the same poisoned securities, and now they too began to fall. In Iceland, the entire banking system collapsed almost overnight. From London to Tokyo, markets plunged. What began on Wall Street had become a crisis for the whole world. But for ordinary people, the rescue came too late. As the crisis spread into the real economy, businesses closed and millions lost their jobs. Families were thrown out of the homes they could no longer afford to keep. Economists gave it a name that echoed the 1930s, the Great Recession. In the United States alone, the unemployment rate doubled, climbing to nearly 10%. Almost 9 million jobs vanished. Factories fell silent, offices emptied, and for millions, the world of steady work simply disappeared. Entire neighborhoods emptied out, filled with foreclosed and abandoned houses. The savings that people had built over a lifetime were wiped away. For countless families, the damage would last for years or forever. And as the public watched the bankers who caused the crash walk away with their bonuses intact, a deep anger took hold. People took to the streets, demanding to know why the guilty were rewarded while the innocent paid the price. To stop a second Great Depression, the world's central banks did the unthinkable. They slashed interest rates almost to zero and began creating money on a scale never seen before, pumping trillions into the wounded system. Governments spent vast sums to keep their economies breathing. Slowly, the free fall began to ease. The world economy did not collapse entirely, but it came terrifyingly close. Recovery was slow and painful, dragging on for years. The wounds it left behind in trust and in fairness never fully healed. There was a bitter irony in the wreckage. The strongest banks swallowed the failing ones, growing larger than ever before. A handful of institutions now held more of the nation's money than they had even at the height of the boom. The banks judged too big to fail had only grown bigger. Reforms were promised, some rules were tightened, but the banks grew even larger than before, and the same reckless gambling